Welcome to another episode of Top Stocks by a former ex-Goldman Sachs employee, ex-hedge fund analyst. In this video, I'm going to go over my top stocks to buy for May 2022. I've personally researched hundreds of companies, and this is my list of undervalued stocks to buy right now. If you watch all the way through, you will get my full analysis of all these companies, and mixed in, I will give you my price targets. I'll go over the company's financials, recent news, and why I expect the stock to grow. Don't like nothing or smash nothing. I'm just going to show you how to make some money. First stock we will discuss today is Sofi. Recently, they announced they're cutting their earnings guidance for 2022. But given they're about $7.50 per share with an RSI of 36 and well below their moving average of $10 per share, I find this stock a very attractive buy. Sofi Technologies provides a digital financial service. It operates through three different segments: lending, technology platform, and financial services. The company's lending and financial services and products allows its members to borrow, save, spend, invest, and protect their money. Sofi is a big player in student loan refinancing. Recently, the White House officially extended its pause on most federal student loan payments. This has been in place since the pandemic began in March 2020. The student loan moratorium was supposed to expire in May after several extensions, but now the moratorium will be extended until the end of August. This has spooked some investors, but what my experience has taught me is to take advantage of short-term fear. That's why I am sharing this opportunity with you. Student loan originations had been picking up in the fourth quarter when people expected the moratorium to expire in January. In Q4, Sofi generated nearly $1.5 billion of student loan originations, its highest volume in the preceding 6 quarters. Now they will again likely pick up, and interest in fees will still come into Sofi, just a little bit delayed. Chief Executive Officer Anthony Noto said Sofi forecasts baked into the fact that it expects the moratorium to extend beyond 2022. So overall, a small extension doesn't change anything at all, as Sofi already expected this, and while they wait, they're just going to kill it on the fintech business side. This is a chart of their members and products. Sofi's financial services productivity loop lowers customer acquisition costs, and the convenience factor is resonating with customers. The company added a whopping 523,000 new members during the last 3 months of 2021, and that was before 112 million people watched the Los Angeles Rams win the Super Bowl at SoFi Stadium. Overall, I expect Sofi stock to rise. The 52-week range is $6.97 up to $24.95. Its market cap sits under $6 billion and a 1-year target of $14.35. Sofi is a top stock to buy based on its huge correction. I'm buying the dip on Sofi, and I have a price target of $15 in the next 12 months. Next stock is Shopify. Shopify has been sold off heavily in 6 months, losing over 65% of its value. The company is growing so fast though that Amazon is targeting them with a new buy with Prime service. Amazon has taken notice of Shopify and sees them as a threat. The real reason I like Shopify for May is their business expansion plan. For example, Shopify Inc. is talking to buy technology startup Deliverr. Deliverr uses analysis to predict where people might be interested in buying art supplies, makeup, shampoo, and other goods. Then it uses that information to position items in warehouse networks to achieve swift delivery before customers even order that product. Imagine this: before you even want something, they already know that you want it. And I had a consulting class in college, and at Amazon, they position goods in their warehouses before the customer orders it, and that is what Shopify is going to do as well. The way this works is based on data. They know there's a very high chance or very high likelihood that they're going to have orders, even the exact quantity of orders, and they position those goods in advance. This deal for Shopify would be a game changer, especially as Amazon.com has doubled its logistic network in the past 2 years. Shopify has some great fundamentals, currently sitting at a 22 price to earnings ratio. The market cap is currently $65 billion, and they have $7.8 billion of cash on their balance sheet. That's 7 times more than the amount that they have in debt. Now, Shopify is going to continue to grow rapidly, which is why I believe concerns over the firm's top line growth, as well as the share price dropping below $6 $600 and below $500 are completely exaggerated. The firm is expecting to grow its top line by 30 to 35% annually over the next 3 years. Because of the material growth in revenues that is expected to benefit the e-commerce firm in the foreseeable future, Shopify's price to sales ratio of 9 is very cheap. Just keep in mind, Shopify is adding more engineering and commercial talent and is focusing on critical investments like international expansion, simplifying fulfillment, building direct-to-consumer solutions. All of these things they're working on. This can impact the margins, but I'm bullish on the stock's future. In May, we can see the stock start recovering, and I have a price target of $750 in the next 12 months. Next stock, this is going to be a bit controversial, but it's going to be Netflix. As it continues to sell off after another wild swing downwards, I want to start recommending the stock as a value play. Establishing a small position to test the waters after the selling is over could make really good money. The actual earnings were not that bad, but the subscriber and revenue figures were less than expected. The price to earnings is now under 20 and the market cap is under 100 billion. In November, the stock traded for over $650 per share. Many investors have given up hope on Netflix stock, but tend to forget that uncertainty provides the best long-term buying opportunities. I made a lot of money trading spreads on Tesla when it was under $300, when everyone was fearful and very concerned that the stock had no future. And I took the opposite stance. Competition is heating up, but I'm still betting on Netflix, and I'm betting on Netflix CEO Reed Hastings to solve Netflix's short-term problems and return value to shareholders. I recommended NIO at $4 and Tesla under $300 in 2021 when nobody on Wall Street really wanted to buy those stocks. Now, Netflix is sitting in a similar position where nobody wants to buy the stock. Netflix finished Q1 2022 with $7.8 billion in revenue, up about 10%, and generated $1.5 billion in net income. Global subscribers did decrease by 200,000 from Q4 2021 to 221 million, but that's still up 6.7% year over year from Q1 2021. Here's what I think will happen in the future, and more importantly, why. First, I applaud Netflix for allowing subscriber sharing because it helped bring a lot of eyeballs to the business and push forward the video streaming era for Netflix and just generally streaming as a whole. However, this convenience has cost Netflix a fortune in potential lost revenue. The company estimates nearly 100 million households are using another household's Netflix subscription to access content. The average Netflix membership cost is about $10.95, which adds up to over $12 billion in lost annual revenue. Netflix is offering an extra household feature on its plan, but the company needs to invest more heavily in IP address limitation and cybersecurity to prevent this from happening. Now, let's say that Netflix can convert just 20% of these 100 million households into paid subscriptions. We're now looking at a company with 241 million subscribers, and investors can no longer spew the lies that growth has peaked. Netflix CEO Reed Hastings launched the world's fastest ever global streaming platform service back in 2007, and now competitors are finally catching up years later. In my opinion, Hastings is literally Elon Musk of the streaming industry. He identified a problem with traditional cable TV, he gave the consumer a better option, and he totally won them over. That's why I believe it's a good time to get into Netflix coming into May 2022, as it's cheaper than it has ever been, or really has it been in several years. My price target for Netflix is easily back to $500 in the next 12 to 24 months. It may take some time. However, I do believe the stock has a very big potential. Last stock, and this one you really need to listen to the full analysis because I have a few charts that you need to understand about Google. Mark my words, despite its superb business fundamentals, its valuation is compressed both in absolute and relative terms. In absolute terms, Google's accounting PE is about 22.6. In relative terms, it's substantially lower than the overall market. For example, the current valuation of the NASDAQ 100 index is about 33. So Google or Alphabet, the parent company, they are cheaper than the overall market by almost 1/3 for both Class A and Class C shares. While Google is overall a stronger business than most of the businesses in the NASDAQ 100 index, obviously, main advantages are its moat, high profitability, and the company is essentially debt-free. Not to mention that I say that it's higher quality and still lower valuation. Also, interest rates and inflation are major concerns for investors. The 10-year Treasury bond yield rate is pushing towards 3%, the highest level since 2018, and the FOMC members are expecting future rate hikes. In the meantime, inflation is around 7%, making real bond rates negative. Essentially, there is no point in holding bonds. As interest rates rise, since Google has no debt, it's not going to be affected at all. Google doesn't pay a dividend, but if you look at EPS, it was around $112 per share in 2021. If you divide that by the current price of around $2,400, you will get a 4.6% yield. Also, considering the company is growing fast, you're taking a very low risk investment that generates higher returns than bond yields at a growth rate of 30% on its business. So at this valuation, you have a very high yield, low risk bond. Now, because the stock is expensive, you can also buy a leap option. I made a private video you can watch in the description for the top leap options in 2022, not on YouTube, which is still valid given the market is selling off just like it was in January. Check out that link in the description, and I'll see you in the next video.